When it comes to new technology, there is usually a frenzy of speculation that drives stock prices to astronomical highs based almost entirely on the expectation that the company being invested in will win the sector, or, at the very least, achieve some significant level of success in capturing a chunk of the market share. This sort of rampant speculation was what led to the insane valuations that were seen in the lead up to the dot-com crash. Sure, if you happened to bet on Amazon or Microsoft at the time and decided to hold, things would have turned out pretty well for you in the long run. But most of the inflated tech companies at the time ended up filing for bankruptcy or getting acquired for pennies on the dollar. This sentiment of needing precision to pick the winners of hyper-popular emerging industries was recently pointed out by Warren Buffett during the 2021 Berkshire Hathaway annual shareholder meeting. During the meeting, Buffett shared a slide of former American car manufacturers that went defunct during the automobile revolution. The moral of the presentation was that there were so many failed contenders attempting to succeed in what would become the revolutionary automobile industry that it took a whole slide just to highlight the failed ventures beginning with the letters MA. The reason I mention this is because I believe that the current electric vehicle industry is in a similar situation to that of the automobile industry in the early 1900s. So when it comes to picking a winner today, things might not be as easy as they appear. Taking a look at our options, there are a few different ways that you could try to pick a winner. You could go with the common approach of trying to buy the current consensus favorite of the industry, Tesla. But at Tesla's current prices, you'd need to be very confident that not only will it be able to continue to grow revenue for a long time, but also find ways of increasing earnings. Meanwhile, the company is facing fierce upcoming competition, potential advances in technology that could render their advantages moot, and regulations that may affect future growth vectors that are arguably already priced into the stock's valuation. Now, I will say that it is very possible and even likely that Tesla succeeds in the industry. But it's also very possible that Tesla's stock price has already peaked and may not be able to get back to the highs of over $900 per share or even maintain the current $680 per share price, similar to what happened with Cisco Systems, a stock that survived the tech bubble and still operates a quality business to this day. But it is yet to get back to the heights that it achieved in the early 2000s, over 2 decades ago. Alternatively, you could choose to go with one of the old auto companies like Ford or General Motors, which are trading at more reasonable valuations, but whose failure to innovate have led to steadily declining sales numbers while also falling so far behind the competition that there are many valid questions regarding whether or not they can ever regain lost market share. Another riskier option is to go for one of the unprofitable manufacturers that have accelerated sales growth, but where concerns about ever achieving profitability still linger. Then we have the riskiest gamble that we can take, betting on one of the hordes of companies that have yet to sell and ship a single vehicle. Some of these companies exist solely through online pre-orders and prototypes of a product that may never even make it to market. It is here that we find one of the best guarantees in the EV space. That guarantee being that you are nearly certain to pick a loser, and you will lose your money if you buy and hold one or more of these companies for the long term. That's not to say that it can't work out for you if you put your money into the latest EV SPAC. People win the lottery every week, and if you want to take that gamble, I wish you the best of luck. But most people don't win the lottery, and most pipe dream stocks do go bust. All that having been said, I do have for you what I believe is the closest thing to a guaranteed winner in the EV space, and it doesn't involve shorting the losers or buying any options. In fact, it's a good old-fashioned value stock. The only catch is that it isn't technically an electric vehicle company. That's to say, it doesn't manufacture vehicles or parts, nor does it sell technology, research, or services. Yet every single electric vehicle absolutely requires what this company provides. In fact, it's so important that it is the single distinguishing factor in the nomenclature that separates an electric vehicle from just a vehicle. As I'm sure you've guessed, the company I'm highlighting today is an electric utility company, specifically Hydro One, which trades on the Toronto Stock Exchange with the ticker symbol H. I believe that Hydro One is not only set to directly benefit from the EV revolution, but is practically guaranteed to grow for decades to come. As you might expect, with a business that provides safety and security for your capital, you probably aren't going to be able to 10 or 20x your money anytime soon. But if you're an investor who wants to take part in the growing EV space without having to worry about losing your money, then I've created a 4-point outline to highlight why Hydro One might be worth your consideration. Number 1. The business model. Hydro One operates as a utility company that both transmits electricity from power generation stations to distribution stations and distributes electricity directly to consumer homes and businesses throughout the province of Ontario. Hydro One also operates a small telecom business which makes up only about 1% of total revenue, and will thus receive a proportional amount of focus in this video. The business of transmitting and distributing electricity makes Hydro One among the most important needs-based businesses on the market. People need electricity to light their homes, refrigerate their food, power their appliances, charge their cell phones, and if the move towards electric vehicles continues as I expect it will, then it's only a matter of time before the majority of people are using electricity to power their vehicles as well. Now, the name Hydro One might lead you to believe that the company generates its own power via hydropower plants. But this hasn't been the case since 1998, when the Government of Ontario decided to split up Ontario Hydro into separate businesses, more narrowly focused on the individual aspects of power generation, price management, and the business that we're focusing on today, transmission and distribution. These were initially intended to be Crown-owned businesses, but because of the Ontario provincial government's overbearing debt load, a little over 50% of Hydro One was sold to the public over the course of about 3 years. This partial government ownership will be very important for point 2. But before we move on, I want to talk about the environmentally friendly structure of Ontario's generation of electrical energy. Ontario has already managed to completely eliminate the use of coal, and is currently leading Canada in wind and solar generation. Additionally, Ontario generates over 58% of the province's electrical power via nuclear energy, which is arguably the cleanest method of energy generation. When it comes to the push towards renewable and green energy, Ontario is the clear leader, and regardless of your opinion on climate change, there is a clear financial motivation to move towards more environmentally friendly energy sources. In my opinion, this is the single largest factor driving capital into the EV sector. This bodes incredibly well for Hydro One, who only operates in Ontario and who recently partnered with Ivy Charging Network to create Ontario's largest and most connected electric vehicle fast charger network. This network has a planned 73 locations all across Ontario, of which over 23 are already open and operational. Number 2. The moat. Hydro One is one of, if not the most anti-competitive businesses that you can buy into. So much so that I'd consider it to be a virtual monopoly on electrical transmission and distribution in Ontario. The figures really make the point for me. Hydro One's transmission lines transmit 98% of all electricity in the province, and their distribution lines service 75% of the province's geography with over 1.4 million end consumers. The reason that they're allowed to control such a remarkable portion of the market share is because Hydro One was originally wholly owned by the province of Ontario, a decision made to provide an essential service at the lowest possible price. But as is standard in politics, the government needs to find ways to fund projects, and everyone hates higher taxes, so the government decided to sell off half the business. The surprising thing is that despite the current size of Hydro One relative to the market, it's actually expanding. Since 2015, Hydro One has increased its transmission market share from 96% to 98% of all electricity in the province. Meanwhile, their distribution network has added service to over 100,000 new consumers, and all of this occurred during years where the company was actually struggling due to outages caused by depreciating infrastructure and an unfavorable court decision that saw them receive an impairment to the tune of $867 million, which was actually overturned just last year. Nevertheless, this growth despite the struggles faced by the company through to 2019 really shows the dominant position that the company holds as they hastily outpace smaller competitors by way of natural expansion and acquisition of companies who would rather sell their infrastructure than compete in the same space. Since the public offering in 2015, Hydro One has managed to bolster their foothold as the most important electrical company in Ontario. This postures Hydro One with the strong defensive benefits that many companies just don't have. In situations where the economy takes a downturn, one of the last things that people will decide to cut from their budget is electricity. And if threatened with financial collapse, Hydro One would almost certainly receive financial aid from the government, as the alternative would leave countless citizens without power. For these reasons, I don't think that there's much of an argument against the size of Hydro One's actively widening moat. The test of a good moat, however, isn't necessarily how wide it is, rather how easily it can be crossed. So before I go into point 3, I want to explore the potential disruption in the industry and how it could impact Hydro One. In almost every industry, there's always the possibility that some exciting new invention will shake everything up. And in the case of electricity, one such technology is beginning to rear its head. This technology is solar panels and solar shingles, which can be placed directly on consumer homes to generate power, circumventing the entire transmission distribution model of Hydro One's business. The question is, how disruptive are solar panels going to be? Well, solar panels are currently billed and marketed as an expensive upfront cost that can save you money in the long run on electricity while also benefiting the environment. This is somewhat of an accurate generalization that I believe is fairly misleading and not very applicable to residents in the province of Ontario. Let's tackle these points one at a time, starting with cost. According to Energy Sage, the cost of installing a standard 5 kilowatt solar panel roof costs the average resident of Ontario $16,456 Canadian, and the panels are generally expected to last 30 to 35 years. According to the Ontario Energy Board, the average consumer spends $130 Canadian per month on electricity, or $1,560 per year. 16,456 divided by 1,560 shows us that it will take only a little over 10.5 years to break even. Over a 30-year lifespan of the panels, you would save about $30,344. On its face, making the decision to save over $30,000 in electrical bills seems like a no-brainer. But once you look at the upfront capital expenditure used on the panels as an investment, the case for it being a good use of your money falls apart before even taking into account that this is the unrealistic best-case scenario for solar roofs. Regardless, in this best-case scenario, the return on solar panels is just slightly under 3.55% compounded annually, which by investment standards is considered a low return, especially considering that the same $16,456 invested in an S&P 500 index fund can expect to achieve around 7% compounded annually, which is the historical market average. This means that over a 30-year period, the same $16,456 would net a gain of $108,811, nearly 3.5 times greater than the investment into the solar panels. In the much more realistic scenario, however, we would have to account for the average 2 months per year where there is no sunshine, as well as days where the cold weather and large buildups of snow, typical of Ontario winters, would impede the ability for solar panels to generate electricity. To factor this in, we'll assume that about 2.5 months worth of electricity will have to be purchased for $325 each year. When factoring in these additional costs, over 30 years the savings would be cut down to around $20,594, again assuming there is no damage or other problems with the panels over that 30-year period. In this instance, the compounded rate of return comes to just under a meager 2.75%. Now, this comparison does assume that the panels are paid for upfront and that the index investor has some form of income to pay the monthly electrical bill. But in either case, the solar panels aren't as financially sound an investment as they're billed to be. For this reason, I don't think that solar panels will disrupt Hydro One's business due to cost-saving benefits anytime soon, barring significant price reductions in panel costs or significant improvements in the solar panels' generative capabilities. Next is that solar panels are beneficial to the environment, which they undoubtedly are, especially in areas that generate electricity via coal and natural gas. However, Ontario has completely eliminated the use of coal and only generates 6% of all electricity by way of natural gas, making the vast majority of Hydro One's electricity completely renewable and very green. So I don't think that solar panels pose much of a threat to Hydro One in that regard either. That having been said, I think it's important to note that despite solar roofing not currently looking like a significant threat when analyzing it based on the beneficial claims, that doesn't mean that it won't become more popular, cheaper, or better in the future. But for now, I don't see it impacting Hydro One's business in any significant way, especially when considering the hassle of having to get the panels set up and the general notion that solar panels are an eyesore among most homeowners. Unless, of course, you buy a fancy Tesla roof, which will cost you upwards of 4 times more than the standard panels. Fortunately for investors of Hydro One, this technology is still considered to be in its infancy, and it's hard to know whether or not it will be here to stay, or if the rising demand of rare earth metals used to make the panels will drive the prices up further. Put simply, I believe it is too uncertain to stake a claim one way or another on the future of solar roofing, and even if they do become a prominent part of the electrical supply industry, it will very likely be a long time before they start to become a serious threat to Hydro One's business. In the meantime, the likely potential of Hydro One appears promising, which brings us to point 3, the future outlook. As the main electrical utility company in Ontario, Hydro One has the opportunity to greatly benefit from an increased adoption of new technologies that consume larger amounts of electricity, including electric vehicles. The question is, how much will these benefit Hydro One? And that's not an easy question to answer. Sometimes new technologies don't actually meet expectations and end up falling by the wayside before achieving their full potential. Other times, new technologies significantly outperform the expectations of almost everyone. Trying to account for whether or not a technology succeeds leads to drastically different outcomes, and that's before even beginning to account for other variables that have similar divergences. To highlight the difficulty in numerically predicting how things will turn out, here is a graph showing 4 different outlooks on electricity demand in Ontario through to 2035 on the Government of Ontario's website. Outlook A examines a future of low electricity demand. B is a continuation of flat-ish electricity growth, while C and D examine a future with significantly higher usage of electricity due to the increased electrification of transportation and changes in the heating and cooling of homes and businesses. Additionally, Ontario's population is expected to grow by over 35% by 2046. Because of this, I believe it's highly unlikely that there will be a low demand for electricity, and somewhat unlikely that there will be flat-ish electrical demand in the future. Unfortunately, when new technologies receive massive attention, as has been the case in the EV sector, predictions become more frequent and outlandish as more people buy in. In this instance, I'm no different, but I'm going to try and keep my predictions on the conservative side and base my model off of an accredited recent prediction made by Transport Canada. In late 2020, Transport Canada set targets to have 10% of all vehicles on the road be electric by 2025, 30% by 2030, and 100% by 2040. To me, it seems implausibly lofty to have 100% of all vehicles on the road be electric powered by 2040. The idea that there won't be a small percentage of people driving non-electric vehicles made in, say, 2027 seems a bit difficult of a scenario to buy outright. Because of how difficult it is to predict future trends, I'm going to modify Transport Canada's prediction targets by increasing the timeline that it will take for EVs to achieve market dominance. Note that this process is very speculative and is only used in lieu of a model put out by the government that is more bullish than I feel comfortable using to base my later calculations off of. Without any further ado, I think it's likely that by 2025, 7% of all vehicles will be electric. I think it'll take a little bit longer than Transport Canada predicts to get the ball rolling, especially with inflation-related costs raising prices. By 2030, I think 20% of all cars will be electric. The cost of electric vehicles and advancements in battery technology will make pricing and performance much more competitive with traditional cars, which, in addition to the government rebates for those who make the switch to zero-emission vehicles, will lead to greater demand as the push towards clean energy will be in full swing. By 2040, I believe that 85% of all vehicles will be electric. Throughout the 2030s, I believe that large-scale vehicle manufacturers will be producing only electric vehicles as they will be cheaper and more capable than their gas-using counterparts. The majority of non-electric vehicle users will likely be people who tend to drive their vehicles until they stop working, alongside a small group of stragglers who cherish and enjoy the process of working on their vehicles and who hold nostalgia for going to gas stations to fill up their tank. I believe that it will take until 2045 for roughly 98% of all vehicles to be electric. By this point, almost all of the ICE vehicles produced pre-2030 will either be breaking down or upgraded, since most gas stations, as we know them today, will be electric charging stations, aside from a few in select larger cities or small niche towns that will provide the opportunity for hobbyists to fill up with petrol. I think that there will always be a small market for car buffs who love their old-style cars, similar to the sentiment today among those who own the classic cars from older eras. To calculate a revenue forecast for Hydro One, we need to add a few variables into our calculations. For starters, the population growth of Ontario, according to the Government of Ontario's Ministry of Finance, is expected to grow by over 5.25 million people by 2046. According to most sources, the average electric vehicle costs about 13 cents per kilowatt hour, and it takes 30 kilowatt hours to drive 100 miles. If we assume that the average vehicle drives about 13,500 miles per year, the average EV will cost roughly $526.50 in electricity per year. I wasn't able to find any information regarding engine technology becoming more efficient over time in terms of converting energy into miles traveled, so we'll maintain the $526.50 figure until 2030 and then reduce it by 10% just to stay on the safe side. To account for the expected decline of electricity costs over time, as projected by the Energy Information Administration, we will adjust the annual electrical cost per EV accordingly. To keep things relatively simple, we'll also assume that the vehicle-to-person ratio in Ontario of roughly 0.88 vehicles for every person continues to be fairly consistent through to 2045. To be perfectly transparent, this number includes trailers, farm, construction, and other off-road vehicles, but does not include any boats or aircraft. I'm choosing to use the total vehicle registration number because I believe that it is very likely that these vehicles will also be powered electrically, as will some boats and aircraft, and other vehicles not included in Stats Canada's vehicle registration report. Additionally, many of these larger vehicles will likely consume more electricity than electric cars and will probably offset a potential slower rate of electric adoption. Finally, these numbers will be based off of today's currency valuations and are adjusted for inflation, though we will calculate for inflation-related gains on expected returns once all other calculations have been made. With that having been said, we can now combine the cost of electricity per vehicle with the projected growth metrics to gain some insight into the potential outlook on the annual consumer electricity expenditure on powering electric vehicles in Ontario. By 2025, the model forecasts that the annual electric fuel expenditure will rise to over $500 million and continue to rise to over $1.5 billion in 2030. This expenditure will then take off throughout the 2030s, where consumers will be spending over $6.5 billion every year on their electric vehicles alone. Post-2040, the growth will decelerate somewhat to slightly under $7.8 billion spent annually in 2045. If EVs do become a mainstay in the human transportation industry and their consumption of electricity follows the trend line shown in green, we can expect to see growth at the top line of Hydro One. To calculate how much of this expected EV revenue will go to Hydro One, we will calculate what percentage of consumer electricity expenditure in Ontario makes it to Hydro One's top line. To do that, we take the total electricity usage of the province provided by the Independent Electricity System Operator and multiply that by the average consumer cost, then divide that into Hydro One's annual 2020 revenue. Assuming the same 13 cents per kilowatt hour on end-use electricity prices in Ontario, 132.2 terawatts cost consumers roughly $17.3 billion in 2020. Hydro One revenued about $7.3 billion, which means that Hydro One received about 42.4% of the province's consumer electricity spending. If we assume that this percentage will continue to remain stable over the coming years, we can create an accurate revenue forecast based on the information that we have today. Note that while this forecast may be accurate today, any number of future changes in the variables that we're using can drastically change the predicted outcomes, so the projections will need to be updated as new information comes out. No model can precisely predict the future consistently, but we can use forecasting to give us a general idea of what to expect in the future based on the best information that we have available today. With that said, to calculate Hydro One's total revenue forecast, we'll start by taking the mean of Outlook C and D from the Ontario Electrical Demand Forecast projected by the Government of Ontario and factor in future pricing. Post-2035, there is no electrical demand data provided, so we'll take the future population growth projections and find the average ratio of population to consumption and extrapolate. In 2020, the ratio was 8,965.73 kilowatt hours per person. This was low due largely to the lockdowns, but should increase steadily to near 9,739.04 kilowatt hours per person by the end of 2030. The increase in gross electricity consumption appears to be roughly 1.2%, compounding annually, which we'll assume stays consistent through to 2045. This results in consumption of over 195 terawatt hours in 2040 and 210 terawatt hours in 2045. If that's the case, then we can expect revenue to only grow a meager 51.6% over the next 25 years. This top-line growth is not good, but thankfully just because top-line growth of a company doesn't look great, this doesn't mean that the company can't have solid earnings and dividend growth. In this specific case, most of Hydro One's transmission and distribution network is already set up and should be capable of handling greater electricity consumption. Now, there will of course be some added costs, but I believe it is likely that a significant amount of the revenue coming from EV usage and population growth should end up hitting the bottom line, which will end up being redistributed to shareholders in the form of large dividend raises and potentially share buybacks, which will also push share prices upwards. Before we get into earnings growth predictions, you should know that these figures are entirely speculative. There are way too many factors to confidently and accurately predict future earnings growth of any company. And this model is based heavily on the belief that Hydro One is capable of capitalizing on the future growth vectors, and that these vectors play out as predicted in the model. These assumptions are also based entirely on my own research and opinions, and I have been wrong in the past and may be wrong in this instance. So it is very important that you do your own research and come to your own conclusions before ever investing any of your own money. To calculate earnings, we're going to take Hydro One's historical average net profit margin and apply that to all non-EV revenue, and then add that to a series of potential outcomes based on different profit margins that could be generated from charging electric vehicles. The idea here is that electric vehicle charging will likely occur mostly in places where there is already a transmission and distribution network in place to service electricity. This means that there would be no additional infrastructure costs with more electricity usage, which should translate into a greater profit margin. Now, I've also calculated scenarios where EV revenue converts into around average and below average profit margins, even though I don't think that these scenarios are very likely. Note that for this process, we will be using adjusted earnings as opposed to standard earnings in order to avoid irregularities which may make these already speculative predictions significantly more spurious. If we take the average of all Hydro One's reported historical annual net income and divide it by the company's average historical gross revenue, we get Hydro One's average annual profit margin, which is approximately 12.14%. Applying this to our dataset, we can see that profitability through to 2045 differs greatly depending on the net margin from EVs. In the least likely scenario, EVs would, despite being a massive revenue generator, translate into literally no profit. Whereas in a highly optimistic scenario, where EVs are netting a 50% margin, the company would see a 287% gain in net income through 2045. In a more realistic scenario, we could see Hydro One achieving around their typical 10% historical margin on EVs, which wouldn't be implausible, but still wouldn't exactly be likely, considering the lack of perceivable costs on surplus demand at this time. In my opinion, the net margin on EVs will likely be somewhere in the ballpark of 20 to 40%, probably in the low 30% range if I had to guess. The repairs to infrastructure, costs of maintenance and personnel, continued expansion of the grid, and lowering cost of electricity will still likely eat somewhat into profits. But the growing electricity usage in areas that already have an established grid capable of supplying greater electricity needs should allow for a good chunk of this revenue to make it back to shareholders. How all this translates into stock price is hard to say for sure. In a rational world, pricing would likely track growth metrics and expected returns. However, it's entirely possible that the company becomes discounted because of the low projected revenue growth. It could alternatively start trading at premiums thanks to stability of business operations throughout dire financial times. Hydro One's share price could whipsaw over any number of bullish or bearish opinions throughout the years, but no matter how the cost per share turns out, the return to shareholders should remain consistent. In Hydro One's case, this will likely come via dividends, but may at some point also include share buybacks, though we won't be counting on that happening in our calculation. Due to the stable nature of Hydro One's recurring revenues and profitability, the company has historically paid out between 70 and 80% of earnings to shareholders, which currently results in a 26-cent quarterly dividend per share, a roughly 3.5% annual yield on current share price. Assuming the company continues to raise their dividend alongside profits by committing to a similar payout ratio while also choosing not to dilute shareholders by more than 0.25% annually, which shouldn't happen due to relatively stable debt maturity and growing cash flow from operations, investors can expect to receive a recurring annual dividend between 6 and 9% annually by 2045. Assuming the mean scenario, an investment in 2020 would generate a cumulative $43.85 per share through to the end of 2045, a 145% return on your initial investment, not including the share's own appreciation. If we assume that the dividend yield continues to be at 3.5%, then the shares would appreciate to about $67.14 each. making your initial investment of $30.30 per share worth about $110.99, a total return of over 266% without reinvesting the dividends. Compounded annually, this comes out to about a 5.33% return. If we account for future inflation of roughly 2.3%, then these returns get boosted to 7.41% compounded annually, for an investment value of over $180.88. These are returns of nearly 5 times your initial investment value over the 25-year period. If you were to decide to reinvest the dividends, then the total expected value of the investment grows significantly to over $158.64 without any inflationary boosts. That's a compound annual growth rate of over 6.84%, and the reinvestment would more than double your total shares over the 25-year period. If we add in expected inflation, it would further push the compound annual growth rate to over 9.2%, making your initial investment of $30.30 worth $275.20 for a gain of over 800%. This is slightly lower than the S&P 500's historical market average return, but it provides an added level of security over investing in the broad market, which we will cover now in point 4, the margin of safety. When it comes to predicting the future of any company, it's easy to find yourself taken with the positive side and fail to account for things not quite going to plan. The same can be said for groups of companies, say those making up a market tracking index fund like the S&P 500. That's to say, it's easy to plan for and expect the continued 7 to 10% plus gains of the S&P. But the pattern of the past 10, 20, and 100 plus years doesn't guarantee a similar future return, especially when we consider the high likelihood that we're entering a new economic ambiance that contrasts with the historical experience of North America for the past 150 years, arguably even longer. Over the next decade, it's expected that China will overtake the United States as the dominant economic power in the world, which may pose a serious threat to the United States, who's been using their position as creator of the world's reserve currency to operate an annual negative trade balance to the tune of nearly $916 billion annually as of 2020. This means that the US must print currency or issue debt every year in order to bring in the goods and services needed to meet the country's demand. The US recently printed a historical amount of money to offset unemployment in 2020 and 2021. If you're a country who's selling goods and services to the United States that are being paid for in United States dollars, and the value of what you are given drops significantly when compared to what you traded for it, you're probably not going to be very happy with your trade. Nor are you going to be too happy about the way that the reserve currency was diluted, especially compared to the Chinese yuan, which has been outperforming the dollar throughout the past year and a half. This threatens the global trust in the US dollar and adds another concern to America's foothold over the world reserve currency. The fear is that if the US loses this position, they may also lose their ability to get away with simply printing money to maintain imports required to supply the country with what it needs. If this happens, it would lead to a drop in business productivity and an increase in unemployment, which would in turn negatively impact almost all of the underlying businesses in the S&P 500. Now, this isn't guaranteed to happen, but it is a real possibility. The point of all this is that I don't know how the broad index will fare in this or any number of other economic scenarios. What I do know is that regardless of what happens in China or the United States or anywhere else, even if things become dire, the citizens of Ontario will still use electricity. I also have a pretty good idea that the population of Ontario will continue to grow alongside EV adoption and the fight against climate change. I also know to keep an eye out for solar roofing technology and other potential risks towards Hydro One's business. Most importantly, I know that I can feel confident in my investment because I understand the business, which means that if the stock price increases, decreases, or stays the same, I feel secure in my position, and if something new changes the circumstances surrounding the business, I can make an educated decision and evaluate how the changes will impact the business itself, without having to rely on emotion or herd mentality. Hydro One is a business that I believe will not fail to return more money to shareholders over time, and alongside that built-in safety of the business comes potential growth boosters that make the company a good place to invest for stability and moderate growth in virtually all scenarios. This is why Hydro One has such a large margin of safety. So those are my 4 points. To finish up this video though, I'd like to reflect on a quote from Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I believe Hydra One is a great company trading at a fair price. Now yeah, it's always better to buy a great company at a great price, but in today's market, it's not so easy to find bargains on quality. That's not to say that these opportunities aren't out there or that they can't be found. They certainly can. But if you're gonna go digging for gems, you better prepare to put a lot of time aside before you start sifting through the dirt, and you really better know what you're looking for. Hydra One, on the other hand, doesn't require too much sifting. It's a stable earning large cap company that has growth opportunities from upcoming technologies that rely on the service that it provides. The company has few competitors and has strong government backing with a low likelihood of being disrupted. These considerations, alongside the metrics including a reasonable PE of around 20, a tangible price to book value below 1.8, and the stable 3.5% dividend, makes investing into this company more than reasonable for me. Personally, I use the stock to store most of my surplus cash in my Canadian portfolio. The dividend income provided by the company is nice for reinvesting, sometimes back into Hydra One and other times into different companies if I conclude that they offer a better opportunity. Of course, Hydra One can be utilized efficiently in several different types of portfolios as more than just a store of capital. The dividend growth might make it attractive to someone looking for long-term stable income. Hydra One could also draw the interest of investors who are socially conscious and who want to invest in companies that are moving society towards a greener future without having to gamble their retirement fund on a company with high valuations. Or maybe Hydra One could be seen as a good opportunity to take some profits off of the table for investors who have done well in some of the riskier stocks over the past couple of years. In any case, I think Hydra One would be a good addition to many Canadian portfolios, especially for novice investors who want to learn to start investing for themselves, but who also want to fortify their temperament against the volatility of the market, without having to worry about losing everything along the way. If you're considering Hydra One as a potential investment, then I'd encourage you to look into the company further to gain additional insight into why you would or wouldn't want to own the stock. For the purpose of full disclosure, I myself do own shares of Hydra One, and have made Hydra One into my second largest position, with a cost basis of around $29.20 per share, purchased mostly throughout January and February. I still believe that at the current price, Hydra One provides a good investment opportunity, but I'm not a financial advisor. I'm just a Canadian who likes investing, and this is my first video on the Canadian Investing channel. If you liked my presentation and analysis and would like to see more content from me, like how to find great businesses at great prices and how not to confuse a hidden gem with a dirty rock, then consider subscribing to my channel. And if you think that this video will benefit someone that you know, consider sharing it with them. Thanks for watching, and enjoy the rest of your day.